Right, good afternoon, everyone. Hope this finds you well. Top of the afternoon to you from a rather overcast London. I'm Rob from The Lazy Trader, and today we're basically going to be talking about how you can profitably trade the news without really having to care about the news, know what the news is, worry about the ramifications. And a lot of people really do fall down in this area, flat on their face when they're trying to trade the news, and they make it a lot more complicated than it should be. So, with this webinar, I want to really kind of simplify it for you and teach you a way of trading the news where you can really make it as stress-free and as emotion-free as possible, okay? But before I do that, before we proceed in earnest, I just want to tell you that I've been trading for about 7-8 years now. I've made every single mistake in the book several times over, and I'm not ashamed to admit it. And certainly from my development, I decided to go the hard way and figure it out for myself. And eventually one day I discovered a way of trading set and forget strategies where you can just simply set them up, set your orders up and walk away without really having to stress, think or worry about your trades. And that's what really trading should be for a lot of people. A lot of people choose trading to really kind of like make money, make a better return on their money, and in the most efficient way possible. But the irony of it is they spend more time than ever beyond their wildest nightmares in front of the screen trying to chase the dream, when in fact they could actually do it quite simply. And learning how to profitably trade the news in this webinar will give you the cornerstone for doing that. And one thing, I just want you to have a quick look at the disclaimer, just very briefly. There are no howlers in there, don't worry. Okay, so first things first, why don't we need to worry about the news? Well, you can do if you want to, but if you're trading end-of-day strategies with a high reward, you have the option, thank goodness, where it's not necessary. The reason is because we're human beings. We haven't got some kind of Jedi psychic skill sets which no one else has. We haven't got this innate ability to predict the news, so we can't do it. So we need to accept that. Also, not really worrying about the news gives us an extra peace of mind. We could accept what happens if news does happen to go in our favour, and we can accept what happens if news doesn't happen to go in our favour. And as I just hinted just before the webinar started in earnest, having high reward to risk will carry us long term through trading the news, even though we don't really care what the news is. I mean, last Friday we had non-farm payroll, and sure enough, it's strength of the dollar off the back of it. We wanted the dollar to pull back, but we can just accept that news will do its thing regardless, okay? The reason why we're lazy traders and we trade the daily and the weekly time frame is because not only is it more immune to news, it's more immune to these intraday spikes, these inexplicable spikes which you sometimes see in the markets, even on a quiet day. The daily and the weekly are typically immune to that. They've got a much higher market order and structure, and we're able to make our entry and our stop loss further away from where we would if we were trading a smaller time frame like the hourly or, God forbid, the 15-minute chart. Okay, so us technical traders, whether it's currencies, stocks, or commodities, whatever the asset class, we're trading with probabilities according to what we see on the charts, the levels and the signals in the form of a price action based setup. We do not trade what we think. And people who try and blindly trade the news, trying to second guess the news, are really trading what they think. And that's a sure way to blow your account, unfortunately. Okay. So what we do as technical traders, I'll repeat this and I'll say it until I'm blue in the face, we trade what we see, not what we think. Okay. And we don't look at the fundamentals. Really, it's good to have context in order to really align with a technical setup. But unlike the hedge funds and the institutions like Goldman Sachs, JP Morgan, Credit Suisse, we don't have hundreds of thousands of pounds to lavish on research departments. We're trading, as I said, what we see on the chart and according to probabilities, not what we think as a result of number crunching. Okay? We don't have inside access to a mole or government agent. We're not James Bond. We don't have the inside shout from these lawmakers. So what we need to do is try and rationalize that news can sometimes go in our favor and sometimes it will go against us regardless. Okay? I was speaking to somebody the other day about trading, and they said that they subscribe to this tipping service about what news announcement was going to give the figure for non-farm payroll and what the figure was going to be. And he'd been signed up to this agency for about a year and a half. And basically, in some of his experience, he basically told me that they got it right half the time and half the time they got it wrong. Well, quite frankly, we could do the same, to be honest with you. So if we see a technical setup with a 3-to-1 reward to risk a potential gain, and we're risking 1%, it makes sense to trade the news regardless, or in the way of the news regardless, because if the news goes against us, we lose 1%, plus worst case scenario slippage. If the trade goes in our favour, then we stand to make or have an increased likelihood of making that 3%. Okay, so we can use it to our advantage, and if we're keeping the risk low and going for setups with high reward potential, we can manipulate the news in our favour, so to say. Okay, so just to really kind of re-emphasize this point, the reason why we always go for trades with a decent reward to risk, I'm talking a minimum of a 3-to-1 or up 2-to-1 if it really does look like there could potentially be more upside to be made from more aggressive targets. We could accept that there's 50-50 news can go in our favour or it could go against us. We could be right, we could be wrong. You've probably heard that one before. So if, for example, we're risking 1% and we know that news could either be right or wrong, 50-50, then if we're wrong, we lose 1%. But if we're targeting a trade with potentially 3% that could be made, then we know that if we are right and the news does go in our favour, not that we know, but we're just going on the probability here, then we stand to potentially make 3%, or at least have the outcome of a winning trade in a far shorter space of time. That's the great thing about it. That's reward to risk. People do try this with a 1-to-1. The problem with a 1-to-1, you're just risking 1% of your trading account in pursuit of 1% reward. The problem is sometimes slippage will cost you more, and essentially that 1-to-1, risking £100 to get £100 will be skewed in favour, unfortunately, of a greater loss if you're slipped in and slipped out of those trades. Okay, so it's like the same principle really is like flipping a coin, knowing full well that if it's heads or tails, whether it's heads or tails, if you've selected the heads and you're right, you make, say, for example, $150, whereas if you're wrong, you only stand to lose 50. And it's very much like this with looking at positive reward to risk in our trading here and trading news. For your information, for those people who do trade the higher time frames and are trading a tried and tested strategy, and you're back testing, for those who are slightly more experienced and have back tested their strategy, and it's something I recommend you do. It's a bit like doing the washing up. It's not particularly interesting, but it's a worthwhile exercise. Increasing your screen time and your kind of intuitive perception of price action. What you'll discover is that you'll just see whether your strategy has worked or whether it hasn't. When you're doing your back testing, you will not be gauging the news or taking that into consideration when you're seeing whether your setup's worked or not. You'll just be seeing black and white whether a valid setup based on your rules for entry had a winning outcome or a losing outcome. It's as simple as that. The moment you bring news into the equation is the moment you really bring an extra element of subjectivity into it, and you don't want to do that with your trading. We want it to be as objective as possible. Okay, so looking for trade setups with a good reward are absolutely essential in order to trade the news profitably long term. We don't really even have to really worry about the news. I know, sure enough, the first week of the month is usually the most volatile with all these announcements from the various central banks around the world, Australia, America, the Fed, you name it, New Zealand as well. But we just got to take the rough with the smooth here, knowing full well that if we're wrong, and then we stand to lose 1% of our trading account. But if we're right, then the announcement, if it's in our favour of the trade, then at least it's helping to perpetuate a winning trade far quicker. Okay, so looking for trades with a positive reward to risk. Okay, sure enough, the setups aren't going to be as frequent as trades of a 1-to-1, but certainly they're more worthwhile. So it will encourage you to stay out of the market until you do see a trade setup with decent reward to risk. And that's half the battle, knowing when not to trade. And there's absolutely nothing wrong with deciding to stay out the market if you've told yourself, hey, I haven't seen a trade setup which really matches my high standards in looking for a decent reward, I'm staying out. That's absolutely fine. Okay, and we're looking just to take high probability setups with a decent reward potential. We're not trading currencies or anything for that matter just to swing the bat. But believe me, a lot of people do. A lot of people love to talk about their trading and talk as if they're full-time traders in front of the screen 12 hours a day, but they ironically don't take any trades. That's the delicious irony of trading and traders who talk around the place. Everyone has a view of the market and where it's going to go. But are they right the whole time? Nobody is, let's face it. But the great thing about having a high reward potential is that you can afford to be wrong more times than you're right and still make money. That's the great thing about it, okay? So there's this equilibrium, really. The higher the reward, the lower the probability. But if we've got news in our favour, the 50-50, remember what I said earlier about the news either being in our favour or not, then at least if it's a high reward potential trade, then it's helping to perpetuate it in our favour. But of course, there's that old paradigm when you're looking and selecting for trade setups with a potential high reward outcome. We do need to obviously select the potential reward within the realms of probability, not what you want to happen. Okay, that's absolutely crucial. A lot of people get very misled when they're looking for potential targets because they're confusing what is likely to happen within the realms of possibility versus what they want to happen. And of course, when we're trading and we're in a setup, we want to make as much money in a shorter amount of time as possible. But unfortunately, what I want to happen, what you want to happen, or what the next door neighbour's cat wants to happen is very different to what the market is and what the market will typically do. So we need to obviously align our expectations with what is within the realms of possibility. Okay, so just remember this one. The higher the probability, the lower the reward. These are typically the one-to-one setups, whereas if we're going for the higher reward setups, typically they are lower in probability because you have to wait for a longer amount of time. You're exposed to that time risk in order to come to fruition. But as I said earlier, if news along the way helps to perpetuate a winning trade and you've got a high reward potential, then absolutely fantastic. Okay, so what we want to do, for those of you, I'm pretty sure most of you on the webinar today know about risk management, but for those of you who don't, I just want to quickly go over this. We want to only risk 1% or 2% of our account value, 2% absolute maximum, but we want to pursue, say, for example, 3%. So the formula is simply entry price, takeaway target price divided by entry price, takeaway stop price. I'll show this to you in visual form because I know it's quite, I'm a visual person and I know it's quite difficult to visualize things if you've got somebody on the other end of the line just talking numbers. So don't worry, let's take a view of it now. I apologize in advance for the color of these bars. I'm not really sure why they've come out this color. All I can say is I'll be writing a very strongly worded letter to my charting provider for this. But anyway, you can see here that we've got what many of you probably know or refer to as a bearish pin bar reversal here. One could also view it as an inverted hammer or indeed shooting star. Whatever it is, it's got a tail and it's got an open and close in the bottom third. So here we go. We've got the entry just below the bar, stop loss above the high. So we've got 167 pips difference between our entry and our stop loss, and we've got a potential target of 575 if we are targeting a new lower low here, which looks like it could be within the realms of possibility here, given that it's trending downwards. So it's below the 200 and the 50 moving average here. So if we look at 575 pips divided by 167, well, that's 3.4 to 1. So that means that's quite good reward to risk potential. So that if we're risking £50 on this trade or $50 on this trade, then we could, best case scenario, make 170, which is essentially 3.4 times 50, which equates to 1% of our accounts. We know full well that, sure enough, we might have the Bank of England making an interest rate decision in the meantime, or indeed New Zealand Central Bank. But whatever, we know full well that the worst possible thing that can happen is we lose 1 or 2% of our trading account, or depending on how much you risk, i.e. the equivalent of 167 pips risk. And the best possible thing that can happen, if we're proven right with whatever news announcement might be released, is that we could potentially make 3.4% risking only 1% of our trading account. So how about that? Not bad at all. So this is where we can really just take advantage of positive reward and not really care too much about what the news is saying and who's saying it or how they're saying it or what the number actually is. We can just simply go about our day, rest assured and content with the fact that we know what could happen, worst case scenario, and that's far worse than what could potentially happen, best case scenario. Okay, so we'll try another example here. This is, US dollar versus the Canadian, the loonie, as some of you might know it as. We've got a bearish pin bar reversal, hammer, inverted hammer, whatever you like to call it. It's got a tail and it's got the open close in the bottom third of the bar. Our entry is just below the low, stop loss above the high. We've got 86 pip risk and we've got 245 pips potential profit here. And say, for example, we've got a news announcement in the meantime. Well, so what? We know full well that if the news announcement is in our favour, it will help to perpetuate a winning trade to the point where we've got a 2.8 reward to risk profile. So if we're right and we're risking £100, then we can stand to potentially make 280 because 86 goes into 245. This 2.8 times. But if the news goes against us, then at least we can say that we took the technical setup that fulfilled our rules and we've lost small as well. Okay, but generally speaking, if this is a trend-based trade, what essentially it is making lower highs and lower lows, then the overriding sentiment is already priced into this market anyway. That's the thing. That's the thing about long-term trends and why trend trading is so good, because you're essentially just jumping onto the ebb and flow of the overriding dominant sentiment. You're not trying to trade a reversal and take those multiple hits which reversal traders typically have to endure. Okay, so we'll have a few more examples of this because even though this might seem quite simple, it is very important. And a lot of people really just, a little bit too free or a little bit too loose in their understanding of this. And it is quite a phenomenal thing when you get it right, even though it's not that difficult to get right. So, for example, if we're taking or buying the dip, for example, in an upward trending market, this was euro-dollar quite some time ago. We've got, say, for example, 45 pips difference between our entry and our stop loss, and we're targeting 243. Then we know full well that we've got a decent reward to risk. We've got a 5.4 to 1 reward to risk trade. So we're risking 1% of our trading account. Say, for example, that's £500 or $500. Then we can expect to make $2,700 or pounds, with 500 equating to 1% of our trading account times 5.4. And once again, if news goes against us and causes our trade to stop out, then not only is that a long-term trend or medium-term trend, my apologies, negated, we've also just lost 1% of our trading account. Whereas if, say, for example, news does clash with this trade setup, then at least we know full well that if it goes in our favor, then we stand to make a lot more, or a heck of a lot more, than we stand to lose if we're wrong. That's the bonus. Okay, so last and not least, and a lot of people really overlook these range-bound trades, and range-bound trades are absolutely fantastic because it enables you to get a nice tight entry. But anyway, that's by the by. Here, for example, this is CAD Swiss. I know the chart looks very different now, but say, for example, we've got 38 pips difference between our entry and our stop loss, and we're targeting 508. This was a trade we took, believe it or not. Really fantastic reward to risk, 13.3 to 1, and it hits target. If it clashes with our trade or whenever our trade is open, then, and it's in our favor, then at least it helps to perpetuate a 13.3 reward to risk potential trade. Whereas if we're wrong, then at least we can say that we took this technical setup anyway. Regardless, that's the thing. There's nothing worse than not taking a decent technical setup which fulfills all the rules, and you didn't take it just because of news, and the news just sends it in your favor anyway, and you just got no reason why you didn't take it. You're just nervous. In answer to your question, the time frame, it's a daily. The only charts I really trade are the daily and the weekly for your information. I don't look at anything else apart from just the bars on the hourly to confirm what the shorter term buyers and sellers are saying. Okay, so just in a nutshell, I really just want to kind of emphasize that you shouldn't risk any more than 2% of your account per trade. Never fail to use protective stops, and always pick trades with a 3 to 1 or worst case scenario 2 to 1. but no less. Okay, this is absolutely crucial. But I'm going to show you a couple of examples of trades which live on the chart. I mean, I know we've looked at some in theory here, but I do want you to obviously get a real interpretation of the market right now as it's happening, because anyone could pick beautiful charts from yesteryear and have something to say about them. But if we're looking at the current market, then that really does help to tune your eyes to what we're talking about. Okay, so let's just have a look. There are several big news announcements I want to refer to here. One was certainly in the UK. I know a few of you are from abroad here, but back in September last year, we had an event which could have ended the United Kingdom as we know it. It was the Scottish referendum, and quite frankly, had the Scots got their independence, then in the midst of the unknown, a predicament that the UK hasn't been in over 300 years, then the markets aren't going to react very well to that at all. You could reasonably expect the FTSE to fall off a cliff and the British pound versus the US dollar to fall off a cliff as well, if the market didn't like the fact that Scotland was going to get their independence. And of course, we had a hint of how the markets could have reacted to that. But that's by the by, okay? We have a technical setup on the FTSE. And let's just go to the charts here and just drag them over to the other side of the other screen. There we go. Here we are. So this was September. Let's simulate it. We're already short based on the level. This was the 3rd of September. And we moved our stop loss to the high of this bearish pin bar reversal. Some of our clients took the break of the low of this bearish pin bar reversal with the stop loss above the high. And the premise, the easy, simple premise, that this was just simply at the top of a long-term range. It was the penultimate all-time high. This is the all-time high for the FTSE, unseen since 2000. The year 2000, sorry, when they had the tech boom and that bubble burst, as we all know. But this was a valid technical setup for a short. And of course, Sod's Law, it coincided with the Scottish referendum election. But we knew full well that, okay, if Scotland got their independence, then the markets were likely to tank. If if Scotland didn't get their independence, then it's likely that nothing would happen to the market, because the market would have already factored that one in. The market wouldn't have believed that would be actually possible, or the markets would rally. So we had, on the 18th of September, we had the verdict, and we were already short in this trade, remember. We had, some of us moved our stop loss to break even, and then we had another bearish pin bar reversal. Those people who are really bearish on the FTSE, even though we had the negative, the Scottish didn't want their independence, the FTSE still tanked anyway. Contrary to expectations. But those people who took the trade in the face of the news announcements and the events just held on to their nerve and took the trade and just closed their eyes and dipped their head in the sand. Safe in the knowledge that they moved their stop loss to break even, and they accepted after that the worst possible thing that can happen is they just made no money on the trade versus the potential that they could have made if the FTSE just continued to go down to the bottom of this long-term range here, regardless of what the news said. Okay, the markets can be very fickle when it comes to news and uncertainty, but generally speaking, when there's uncertainty, markets don't like it, and they tend to get jittery and bearish. And they certainly were momentarily when the Scots, well, a poll leaked a week or two before the actual referendum that the Yes campaign were in the lead. But anyway, that's just one example. I want to show you a few more examples, because that's just Scotland, and frankly, there are a lot more examples out there. ECB rate cuts in Europe. This was on the 4th of September last year. And let's have a look at Euro New Zealand. This was a trade which we took. Let's go back. There we go. That's it right here. We had a technical setup right here. There we go. We had a bearish pin bar reversal, also known as a ring high or shooting star, whatever you call it. We had a decent setup. It's a sign that price could potentially go all the way back down to here again. And we had at least a 2-to-1 reward to trade before our first target here at the previous swing low. And we knew full well that, okay, we're triggered into the trade then, and the ECB in that afternoon with their announcement, if they made an announcement which would cause the euro to rally. Then at least we'd only lose 2% of our trading account. But if what they released fell short of expectations, then, well, the fact that they cut interest rates devalued the euro somewhat, so money would have flown away from the euro and caused this to happen. So we knew full well that if we were right, we would have made at least a 2-to-1 profit potential on this trade from if we were right, but if we were wrong, we would have lost just 2%. Okay, and it exceeded our first target, which was fantastic. That's exactly what we wanted. And this is the great thing about news, helping to perpetuate a winning trade or winning sentiment here. And it bounced back pretty quickly, though, afterwards, I have to say, which was unfortunate, but we all got something from it, which was just a pure case in point of really the news just helping to influence a winning trade and giving us the ability to take profit very quickly in a far shorter space of time, rather than being in purgatory. Like, for example, I'll just give you an example of a trade we currently at the moment. We're in a cable short. We took the break of our Friday's low, and cable has been since trigger us into the trade. It's just been moving sideways, and this is not nice. We'd rather just have a news announcement just to simply give us a verdict quickly, whether we're right or wrong, or something just to cause the market to move. I know we're simply selling the rally in this instance in a downward trending, long-term downward trend, but it's always nice to have the verdict quick as possible so you can bank profit and move on without having to babysit the trade or manage it. But essentially, as this is a trend-based trade, as some of our clients will tell you, we're just simply going to be moving our stop loss for every second seller bar. The trade moves in our favour. If it doesn't do anything after 4 bars, then we're just going to cut the trade short. There's no reason why you should just be in a trade for more than 4 days in that zone of purgatory. And when I say purgatory, I'm meaning whether you just don't know whether your trade is going to be a winner or a loser. It's a horrible feeling, and quite frankly, it's far better just to cut your, even if it's a small loss, just cut your losses and just go to another potential setup and move on, rather than just simply enduring this state of limbo. Okay, so that's cable. An example of news as well, which helped to invalidate a setup over the weekend, was a Aussie New Zealand trade. We didn't really, as I said, we don't really care about news, but we had a technical setup we felt for a long based on the reversal, and we trade reversals here at the Lazy Trader. But we were looking to trade the break of the hard this bar here. This is what we call a smash bar, stop loss below the low. And this was Friday. Friday had non-farm payroll day, the day after, but we didn't place our trade until Monday. Sunday, they had news released that basically, which caused the Australian dollar to gap down. And that's because 33%, there's been a 33% decline in Chinese demand for raw materials from Australia. So that caused the Aussie dollar to gap down, and certainly against the Kiwi, the New Zealand dollar here, which is fine because it caused us to invalidate the trade. And we just got out that trade for that reason. And we weren't even triggered into the trade because essentially we got gap down and the low of the activator bar got breached before anything else could happen. So that invalidated the trade setup. I've got some questions here. So, okay. On Thursday, there is an inflation report for the UK to trade. What results would give the cable boost up? Well, that's the thing. It depends what the market is expecting. If inflation is, for example, getting higher or increasing, then you could typically look at the Bank of England to increase, or there'll be pressure to increase interest rates to curb inflation, especially if inflation is really rampant or increasing beyond expectations. Typically, when there's inflation, the country will put the brakes on if the inflation is out of control. And that, in turn, will cause that currency to typically rise in value because investors, will be expecting and anticipating a higher rate of return on their currency, on their investment. Okay, so another question from Manoj. How many pairs of financial instruments do I scan for these setups? Well, believe it or not, I'll let you into a small little secret of mine. I trade exactly every stock commodity or any other asset exactly the same way as I would a currency. Stocks as exactly the same way. Certainly if they're trending, I'll trade continuations on them. If they're reversing, I'll trade reversal-based strategies on them. It's absolutely fine. I mean, currency is all very well and good, but there's more out there as well. A lot of people do think, even though currency is great, they're liquid, they move fast, you get your verdict quickly. A lot of people think that currencies are be-all, end-all. And it's absolutely fine if you say to yourself, look, I just want to trade currencies, that's fine. But there's still a lot more variety out there. I mean, I scan through the FTSE 350, no problem. If it's a chart and you're looking at price action on the chart, quite frankly, you're trading this very same underlying psychology. What you see in the chart relates back to our emotions as human beings, reflecting our chromosomes since the dawn of mankind, essentially. That's what price action is reflective of. Greed and fear. Okay. So these are setups which have basically been as a result of news and how news has influenced them. On Aussie New Zealand, they helped us stay out of a trade setup which became invalid as a result of a negative news announcement. Anyway, I just want to talk to you about the S&B rate cut in 2011. I'm tempted to talk to you about the removal of the floor in January, but that was very much a black swan, and you won't be seeing that again in a hurry. But let's go back to this example for Swiss yen in September 2011. Let's just find this currency. Many moons ago, but this was one of a prime example of what I'm talking about here. And I remember taking this one very clearly when mentoring a client, and we saw at this, we had a ceiling here, a decent rejection, bearish pin bar reversal with an inside bearish pin bar reversal, quite a strong technical setup for a sell. At least we can just take it down conservatively to this previous swing low here and accept this as just a breather up, a lower high before potential lower low could be made. And it just so happened that we were risking 2% on this trade, entry below the low, stop loss above the high of the inside bar. And it just so happened that it decided to cut their interest rates and cause this move. And this was fine. This was absolutely great. It gave us a good 10% gain in a matter of minutes. In fact, it exceeded our first target, so it was 10%. But we knew full well that, okay, it's a technical setup, whatever. It's fine as a technical setup. We knew that the worst possible thing that can happen is that we could lose 1 or 2% trading this setup. But the best possible thing that can happen is price would have come to the previous swing low here, or indeed exceed that, and it certainly did. Of course, you know, if news goes against you, then you do stand to lose a bit through slippage. If you're broker, and that's when I say slippage, I mean that's when your broker can't quite get you out of the trade at your desired level. But typically slippage pales into insignificance compared to not using a stop loss or not risking or keeping the risk small per trade. Okay, so that's very, very important. And typically, just for your information, the first week of every month tends to be the most key for news announcements in gauging the sentiment for the rest of the month. Okay, and in answer to your question, FX Boyke, I always set my orders up with my broker so that I'm waiting for price to come to me rather than me getting in live at market. I'll have it no other way, quite frankly. I just want to go away, set my orders up, go away, do my thing, and come back. And if what I expect's happened, fantastic. If it hasn't happened, then the trade's invalidated or I've been proven wrong, and I've kept my risk small if I've been proven wrong. That's the key difference, really, when it comes to trading and trading with high reward potential. Okay, and that's very critical. So if you just take away these 3 things from this webinar, it's keep the risk small, keep your reward to risk potential positive, and certainly if you're trading the daily time frame or the weekly or above, I know you have a much bigger difference between your entry and your stop loss, but on the positive side, you are immune to these intraday spikes, and you can take advantage of a much stronger market structure. Certainly if you're trading with the trend, that's very, very important, trading with the trend. Essentially in an upward trend, you're buying a dip, like for example with the dollar Singapore, very, very straightforward looking currency, making key higher highs and higher lows, just simply waiting for price to come back to, dare I say, this trend line, retest this previous swing high as support before making another higher high again. This currency is very predictable in its nature, which is absolutely fine. And we know full well that the dollar's strong at the moment. You don't need to be a rocket scientist to not be able to get that. You can just get that by looking at this chart. And if you're trading trend-based strategies, and believe me, there's absolutely nothing wrong with keeping things simple and just trading with the trend. Remember the old cliche, the trend is your friend until the end when it bends. You can just simply buy the dip. And one thing you can do that's just simply waiting for price to make a higher high, come back and retest the previous swing high as support before making it yet another higher high. And this is the great thing about a lot of these dollar-based currencies at the moment. Okay, so this is just an example. In a downward trend as well, let's have a look. One of you wanted to know about cable. Well, we've been in a very steep trend. I'm very wary of these two levels here. We've got key levels of support, 14800. But essentially, I would say that the downward trend is still valid until we get a higher low and a move upwards for cable. Okay, so I'm going to watch its interaction here at 14800. But what I'm really interested in with cable is the next level down, and this is 14884. Sorry, my apologies, down here, because we can see here on the weekly time frame, we are essentially at the midpoint of what is a long-term range here. This is the lowest point cable's been since before 2001, since 1985. Okay, so this is if cable does come down to here, this would be a key buy level for people who trade supply and demand levels. They're pretty powerful strategies, and this is something which we teach to our clients. Okay, so this is essentially how to trade the news or manipulate news in your favor. And this is for those of you who just want to go away and trade the higher time frames, then you can easily, you can certainly get high reward potential in your favor with the benefit of being with the trend. Trading the trend is far more likely than trading a reversal. Okay, so I just want you to make a note of this. Okay, FX Street Feb. As you've taken time out to come to this webinar, I just want to share with you how we can help you. And we've got an exclusive offer with FX Street, where today only we're giving you access to our flagship ultimate course, where you're able to trade any asset class in any market, whether it's a trending or range-bound market, from as little as 10 minutes a day. It's had very, very good reviews from our clients. Our community is expanding rapidly, and it's something which we're inviting you to become a part of. It's valued at $1,997. But for you, we're going to give you a huge discount down to $100.80, so a 60% discount on the online price, which we currently have at $252. All right, so in order to claim this discount for today only, it expires at midnight London time, then simply go to www.thelazytrader.com Forex training, buy the ultimate program, type in FX Street Feb, and this will get you your discount, 60% off discount. And we'll teach you all the strategies which we trade in trending, range-bound markets. You'll have access to market analysis modules, our weekly Market Insider webinar, trade ideas, numerous free bonuses like our Trader Hypnosis Masterclass. And we've got also pattern recognition software as well, and lifetime support. So plenty going on there. And of course, if you don't like it, if you log in, get your password, and you decide it's not for you, then we'll give you a refund, providing you're in the fair use bracket and you're not taking advantage. But I'm sure none of you here will be like that. So, yep, there's nothing to lose from taking advantage and having a look. Okay, so hopefully see you on the other side. It's only open for today only. Go to thelazytrader.com Forex training. and get the ultimate program. Read the T's and C's. Use the promo code ForexStreetFeb. And there you go. Any more questions? Let's have a look. Brokers. Let's have a look. So for the benefit of the room, do you use the same broker for both stocks and Forex, or different brokers seem to be offering different spreads? Well, no, I use a different broker for my currencies account than my stocks account. It's important as well to keep your money segregated to an extent. Certainly in the UK, we do this because the government guarantees up to £50,000 per trading account, per client, per company. So I like to have my money split over multiple accounts. And just a tip here, if you've got two separate accounts with £50,000 in and they're both open under the same company, then you'll only be compensated for one of them. So make sure that if you've got a trading account which meets that kind of limit, £50,000 limit, then spread it in different accounts over a variety of companies, because then you'll be covered by the Financial Services Compensation Scheme. Okay. So I hope I answered your question. I'm actually, do I see another leg up before coming down on the trend resuming? Well, quite frankly, I'm banking on cable continuing downwards as a result of Friday's seller bar. I could be wrong, of course, but I know that if I'm right, then I stand to make at least a 2-to-1 gain. If I'm wrong, I only lose 1% of my trading account. Okay, I mean, cable, it's a thing. People ask me, what do I think is going to happen in the market? And they're generally quite surprised when I say, well, anything. You know, I don't know. I just go on the probabilities. If I've got a technical setup which has high reward potential, then if I'm right, I'm rewarded handsomely. If I'm wrong, I only stand to lose small. Okay, and that's the beautiful thing about taking advantage of high positive reward potential. Okay, so I think that's about it. What percentages are you correct? FX Boyke. Okay. I risk 2% of my trading account per trade, but a lot of people who are new to trading, we recommend that they risk no more than 1% of their trading account. So hopefully that answers your question. Oh, well, you'll be surprised, actually. We have more losing trades than winning trades, but the fact is we risk manage our trades, which are wrong, so we don't take a full hit. As I said, for example, with cable, let me show you a trade in which we were wrong. Aussie yen. This was... Let's go back to the daily. When we're in a losing trade, it doesn't mean that we've taken a full hit. We could have lost small. Yet we still attribute that down to a small loss. Like, for example, this trade here, we had a good setup. This was a classic ring low setup for Aussie yen. This was on the 26th of January, and we got triggered into the trade for a long. This had great reward potential. We got triggered into the trade. Then we had this setup happened. We moved our stop loss to here, just above this point, and we got taken out for half risk. Essentially, we lost half the trade because we're able to protect the downside, because a bullish pin bar reversal followed by a bearish pin bar reversal is a very negative sign, and we know that, so we're able to manage the trade accordingly so that we didn't take a full hit for this one. Got a few more questions about cable. Do you not think a double top in cable first and then a downward trend? Well, I try my best not to think, really. What I saw, what the setup was essentially in cable, which we took, was we saw a retracement here on last week to this horizontal level. If we look the weekly, or this horizontal level coincides with what was testing as support all the way back in 2012 is now testing as resistance. We just saw this as a potential place to take advantage of the continuation to the downside and a false breakout out of this box here. This is essentially a choppy range-bound box. Okay, hopefully that answers your question. All right, with this trade, I mean, it's not really doing much at the moment, but at least I know full well that if today closes as a seller day, I get to move my stop loss to the high of today and at least lock in essentially quite a bit of what I've risked. And if cable does end up going against me, I lose very small indeed. But if cable does go in my favour, then at least I stand to make 2%. So a lot of it is down to managing the trade as well. But this is for a different webinar, for a different day, the trade sizing and managing for the trade. Okay, so that's it from me. I will say thank you very much for coming, and hopefully we'll see you on the Ultimate program. Until next time, if you've got any questions, do write them into the window. You need a crystal ball. We'll see about that. You can always put the odds in your probability. You're welcome. Take care. Happy trading.